Okay, perfect. So thanks everybody for taking the time out of your day to pop in and join us for the passive income calculator and syndication presentation. We're going to touch a little bit today on what syndications are and then why they're so relevant to creating that early retirement model and at the same time creating tremendous amounts of passive cash flow. So I am your host today, Chris Roberts, founder and CEO of Sterling Rhino Capital, and I'm joined by the co-host and founder as well, Paul Wilcox. Paul, say hi to everybody.
Hello, hello.
Awesome. I will be reviewing the PowerPoint for the most part, and then Paul will dive into the calculator because he is the rocket scientist behind it. A tremendous amount of work on that thing, and we absolutely love that tool. So let's get going. Everybody wants passive cash flow, right? It's the number one financial need when you retire. You need cash flow. The ultimate goal is to try to get yourself in a position where when you retire, you have money coming in while you sleep. We call it mailbox money. So first of all, I'd like to get everybody involved, make sure that you're all awake, and would like to ask you to type in the chat how you heard about us. So if it was through social media, if it was a newsletter, if it was on LinkedIn, Google, if there's a certain way that you heard about us, please give us a chat and let us know. Email, all right. Olympia Real Estate Group, cool. Let's see. Marina Point Group, Facebook, LinkedIn. Awesome. Thanks, guys, for chatting in. Let's see. I referred somebody to this webinar. Cool. Well, at least people are listening to me and not just nodding their head. That's awesome. Thanks for joining, Pat. So let's get into it. Here are a couple of scary stats as it relates to retirement. So this is one of those things that's kind of taboo out there. You know, nobody wants to talk about money. Nobody wants to talk about how much they make, and nobody definitely wants to talk about retirement. We think about it, but it's something that we just kind of hold very personal, and we don't get out there and kind of share it with others. And so we want to encourage you to actually talk about this so that you're aware of how much you are actually going to need in retirement. So a couple of interesting stats that we pulled off. The average monthly Social Security payment is about $1,500. The retirement plan for 80% of Americans is just to basically continue working. And of course, that is if you love your job. And even if you love your job, there's going to be a point where physically, maybe you don't want to do it as much anymore, and you're going to need that passive cash flow. Only 30% of Americans agree that they know how much money they're going to need in retirement, and 48% of Americans have less than $10,000 saved. I'm going to take this. Yeah, that's pretty scary, right, Paul? I'm going to take this one step further and say, and this is another crazy stat that's not listed here, is the average American has about $112,000 in retirement. And that's really alarming when you think about it, because if you took that and just put it in a basic calculator with, let's say, a yield or a payout or a amount of money you could live off of, it would be about $500. You could live off that money at about $500 a month for 20 years. And that's really scary because $500, as we all know, would barely cover part of your medications in retirement. So even if you take that with Social Security, it's just not enough. Now, some of you folks may have quite a bit more than that. Some of you may not have even close to that today, but that's what we're going to talk about today. So why are multiple streams of passive income important in retirement? Well, let's think about that nest egg that you have. You know, it can disappear really quickly, and oftentimes it won't even cover your living expenses. And it's nearly impossible to know how much you're going to need out of that nest egg, right? You might sit down with a financial advisor and they tell you to do this, and you'll get this amount of money. But as we all know, life comes at you quick, and you may not be able to stick to that plan. And then at the end of the day, you're never really gonna have a solid plan by the time you get there, and that's gonna lead to absolute disaster. Do you want to live in retirement and be afraid of running out of money? This is true of a lot of Americans. And if you think about it, it's pretty simple to figure out. If the average American has $100,000 in a retirement account and is only going to have about $500 a month, well, they're going to need more of that money quicker, and you're going to run out of it, which is scary.
Hey, Chris.
Yeah.
I'm one of the few who believe in the exponential growth of technology in our healthcare system. And I think our lifespan is going to be drastically different in 10 to 20 years from now. So
yes,
my concern is that we retire at 65 and we're planning on 30 years. And due to technology, next thing you know, we're all living to 110, 120. My kids laugh at me because I tell them, they say, Dad, how old are you going to live to? And I'm like, 178. That's my number. Now they get a kick out of it, but, and maybe I'm not going to go quite that long, But there are some smart people out there that really believe that our lifespan is going to drastically change. That's where this becomes scary with a nest egg. You've got a
Yes,
lump sum of money that you're expecting it to get you 30 years. And next thing you know, you need it for 50 years. So
absolutely.
a passive income stream is what we all need.
Yeah, Paul, that's a great point. And I posted on social a little while back this interesting little chart, and it showed how, back in the day, I'm just going to say, 30s, 40s, 50s. The concept was, you retire at 60 and you live till you're 63, right? But nowadays, people are retiring a little earlier, even say at 60 or 58 or whatever it may be. And they're actually living until they're 78 or 83. So that delta has spread. And to Paul's point, we are likely to be living a lot longer in the future with all the technology. So it's so important to wrap your head around this cash flow thing, and specifically multiple streams of cash flow. Critically important. And then you don't have to live a stressful life when you get older. You can sit back and collect that mailbox money. So what is your freedom number? That's what this whole webinar really is about, is syndications and explaining it. And then also just kind of highlighting what is your freedom number. We call it freedom number. And you can see Paul's shirt there. Hey, Paul, how old are you?
40, just turned 44.
Okay, Paul, when did you retire?
2 weeks ago.
Woohoo! All right. Paul retired, okay, a few weeks ago at 43 years old. Now, I'm Paul's partner, proud to be Paul's partner, absolute rock star. He's my technician, my rocket scientist that builds my spreadsheets and does a million other things for me as well. But he literally retired and is working full-time in the multifamily space. Now, he's in a position to retire and not do that if he wanted to. And real estate helped him to get there. So I really want you to understand, in real person, right there on the screen, that is someone that retired at 43 years old. Now, I happen to be 43 as well, and I'm in a very stable position myself. I have a couple of companies that I'm not quite ready to leave. I love what I do, but I have two partners, actually, Paul's not the only one, that actually retired early as a result of multifamily. So it's real, and we want to show you how to do it. So what's your freedom number? Here's what I want to ask you to do. I want you to think about, and we're going to help you dive into this more in the future, but for right now, I just want you to really think, gosh, if I needed passive cash flow to retire, what would that number look like? And I just want you to type in one number in the chat. Is it 3,000? Is it 2,000? Is it $20,000? $30,000? What's the number that you could live a life of abundance and freedom where you don't have any stress in your life, right? So we got 10,000 a month. Who else? Come on, just give me some numbers. Just type anything in the chat. 5,000. Okay. 30,000. All right. That's what I'm talking about. 30,000.
My kind of numbers.
That's great, man. Oh man. That's like, actually, that's the mortgage on the private island. And then maybe an extra couple thousand for food. 4,500, 20K. Great. Okay. So this is the point. Everyone's throwing these numbers out. Now, we're not going to get into this right now, but I want you to think about, how will you get to that number? So if you were fortunate enough to have some Social Security at the time, right? Because we may not even have Social Security in 5, 10, 15, 20 years.
That's a big point. What is Social Security going to be 10 years from now or 20 years from now? It may not exist.
Right. So even if that was 1,500, like in our example, or even 2,500, that's a drop in the bucket, right? So Social Security, medication cost, housing, whatever it may be, what is the real number and how do you get there? So we want to break that down a little bit for you using a calculator. That's great. Thanks for participating in that. Oh, we got a 15,000. Nice. 15,000. Thanks, Dan. So how do you achieve multiple streams of income or passive cash flow? What do we do to get there? Well, it's by consistently investing in multifamily syndications. There's no secret, guys. We, guys and gals, we love multifamily. And we love it because we offset a lot of risk by investing in it, by bringing a lot of people together and having lots of doors together. Okay, so that's why we love it. And it creates cash flow while a lot of other people run the asset for you. And that's why we love it. So what is a syndication? We're going to keep this really simple for you. A syndication is limited partners get together. Let's say some of you folks, I've been a limited partner. So is Paul. I happen to be a limited partner on 2,300 doors nationwide. Paul has also invested in, gosh, I don't even know how many doors.
I'm at 600 something now.
600 and something doors nationwide, right? And then we also are GPs and owners of hundreds of doors, 200-300 doors ourselves and counting. We're working on another deal right now. So then you take the general partners. You got the passive investors, You got the general partners, which might be like me and Paul and a few others. And then you've got the lender, and the lender is the largest partner. They own the majority of it, right? Because they're giving us the money for the asset. Might be 80% of the assets, 70%, just depends on how much we need and how much we're leveraging on the lending side. And we all get together, okay? And it's all regulated by the SEC. And then we go and we buy this large asset together. So instead of you maybe going in and buying a little, like say, single family, and then dealing with all this work, you partner with us and you almost get a piece in like 3 of those little houses instead of 1, but you don't have to do any of the work and we manage it for you. And while we're at this point, before we dive into our calculator, we'll get there. I just want to say, in full disclosure, we are not CPAs. We are not real estate attorneys. And it's really important, whether you're talking about syndications or talking about passive income and cash flow and returns, to make sure that you always talk to your own CPA, your own real estate attorneys, and just to understand that there's a lot of risk that goes into any of these types of investments. We feel a lot safer and secure here than we do in the stock market, which is why Paul and I have actually converted most of our money over into multifamily assets. And
All
a
of
lot of
it.
others, yeah, Paul's all of it. I've got a little bit left, and a lot of our friends have done the same thing. But there is risk in anything you do. So we just want to make sure you understand that. Full disclaimer, we are not advising you. We're just giving you a little bit of education and encourage you to continue that education. So what kind of returns can you expect? Well, as a passive income return, you can get somewhere between 6 and 8% annually. And so what that means basically is, you put $100,000 in, you might see $6,000 to $8,000 a year in passive cash flow that comes in, right? But there's more to it in multifamily. And we're not going to dive in here on this, but there's a little bit more to it. And that comes in with the average annual returns. So let's just say your average annual returns are somewhere between 15 and 20%. Okay. So you got your cash flow, and then you got a higher number here in the average. Well, how do you get that? Well, you get that because we push the appreciation of the building up, and you get to share in that. So you get your cash flow. And then when we exit the opportunity, you get a piece of that equity as though you held on to a single family for 5 years and then sold it. And there was some equity in there. The difference is we force appreciation in multifamily, where you can't really do that in residential. And that's how we end up doubling the money as an estimate in many cases. You put 100,000 in, by the time you exit, you include your cash flow and your appreciation, and you end up doubling your money, 100 to 200,000. Again, this is just an example for educational purposes, but we have seen this in a lot of the deals out there. Okay. So that's how you get to those numbers: is cash flow and appreciation equals about a 2.0 multiple, or about doubling your money. All right. So here's the calculator. And I'm going to have Paul bring up this calculator, and then we're going to dive into one scenario. And after I explain that, Paul's going to take it away. Do you have your calculator up?
We built this calculator. It's available on our website.
Cool.
You can download your own version of it. And there's also an instructional there, which walks you through in detail every part of this. It's actually quite simple once you get past the initial shock of all these cells, and if you're not a Microsoft Excel expert. But it's very simple. There's only a few entry points for numbers here. And real quick, the reason that I was able to build this is because the returns in multifamily syndications are very consistent, mostly because Chris and I won't buy an apartment complex unless our conservative underwriting allows us to return a specific return to the investors. So if it's not a good deal, we just won't buy it. So if we put something under contract, it's because it makes sense and we are confident we can hit those returns. Therefore, we can confidently project out over a long period of time using this model what your net worth and passive income can look like 10 or even 20 years down the road. Now, I always knew this was powerful, and I was experiencing it myself. And you can figure out maybe what the numbers look like in 5 years, right? On the back of a napkin. But what does it look like 15 years down the road? What do your finances look like if you continue to invest using the multifamily syndication model and treating it like a retirement account, which is why I compare it to a traditional retirement account over here. So that's the basis of the calculator. And let's start plugging in some numbers here, Chris.
Yeah. So we're going to run through a couple of scenarios. And the reason this is really important and powerful is because not only are we comparing it to the traditional stock market, but we're accounting for, and by the way, we had this fully vetted by our real estate CPAs. Okay. So they dove into this to make sure it made sense. Okay. And a lot of those folks have lots of clients that are in IRAs and such. So we took those numbers into account. Why this is so powerful is because the person in this example, we'll call her Sally. Okay. She might make 70,000 a year. And let's just say she's going to invest for 15 years, Paul. Let's use 15
All right.
years.
First cell investing duration period. We're going to take a snapshot of 15 years.
So Sally happens to be 40 years old and wants to retire at 55. We're just going to give you one example. Okay. And she's going to start with $50,000 because by the time she's 35, she might have $50,000 saved up. And we're going to assume it's cash. Okay.
And also, Chris, your
Yeah.
50,000 is typically your minimum entry point into one of these deals. So to get into your first deal, you're going to need at least $50,000.
Yep. In most cases, you are. Some syndications will only let you in if you're accredited or start with 100,000. But for purposes of averages, we'll say, 50,000. So now how much is she going to contribute every month? Well, again, using averages and kind of thinking about Sally making, let's say $70,000 a year, we're going to assume she can put $800 a month in, or what, $9,600 a year.
We'll do 800 times 12. Oops.
I hope my math's right. Is that 9,600?
Hold on. That's right. It's 9,600.
Okay. So 9,600. And then,
all right. So that's the annual contribution after the initial investment. All right. And we're going to have her put in $9,600 a year for the whole 15 years.
yeah.
So that's going to be her contribution rate.
Yeah. So instead of contributing, now this is going to compare, let's say 9,600 into her IRA, she's going to put it into multifamily assets, right? And Paul's going to dive in a second, explaining how these algorithms work, because if you're only putting 9,600 a year in, you can't get into a deal at a minimum of 50,000 every year, right? So he's accounted for that in these algorithms, and we'll get into that in just a second. So go ahead and calculate, Paul, and let's see what kind of numbers you come up with.
All right, we hit the calculate button, and once you get the green okay, your numbers are good. If it still says hit calculate again, just hit the button again.
Okay.
But we are okay. So we're going to scroll down here, and our results are at the bottom. Okay. The important number here is the potential income below the red line. All right. You have an annual and monthly. So Sally invested total out of pocket $184,000 over 15 years. All right. By the end of that 15 years, she is at almost $3,400 a month in passive cash flow. Comparing it over here to what would be a typical IRA or stock market-based account, dividend about 2.5%. She's only making $800 a month. So it's a drastic difference, let alone the net worth. She's looking at about 700 in net worth as compared to 400,000 in the stock market, right? So at $3,400, let's say Sally's like, well, that's not enough to retire. I know a couple people typed in $5,000. What do we have to do to get Sally up to $5,000 a month? Well, it's either time or it's money. We could either extend the time period, or she can contribute more money per year. So let's bump up her contribution amount to $15,000 a year. All right. We'll recalculate. And she's up to $4,300 in income at that point. All right. Let's go up a little more. Let's go to 18,000. Calculate. And we're almost there. Let's do an even 20. Yeah, we broke it. So probably 19,000 was the ticket there. But she's at $5,200 in monthly income in year 16. Now, she's only invested $330,000. I say only, that's a lot of money. But over a 15-year period, I think this is doable for a lot of people. And in year 16, at 55 years old, she's making $5,200 a month in passive cash flow, which I think is pretty fantastic. especially compared to your other options. What are your other options? There really isn't anywhere else you can go and get consistent returns like this. You're definitely not going to get it from a 2.5% dividend in a mutual fund. That's for sure. She'd be looking at about $1,400 a month in dividends. That's not going to work, Chris.
Yeah, absolutely. So Paul, real quick, do you mind scrolling down to the bottom of this so we can
Yeah.
show the power of these graphs? So to Paul's point, and again, you guys could download this thing, you could play with it, you can get it on our website, and put your own numbers in and just kind of test it and play with it, print it, put it on your wall so you got your freedom number. I mean, I love it. You want to have those visuals to drive you there. But what's most alarming, and I'm going to give you another example that Paul's going to put into the calculator, just blow your mind in a second. But if you look at these charts at the bottom, go ahead and go down the bottom right there. Yeah. So if you look at the chart and you see the power of why multifamily, and specifically the forced appreciation part, drives all that value up, it's really alarming. And I'm going to actually show you a real example of this. But if you look at 560,000 versus 1.1, now the questions are, well, how are you going to get there? And what if you can't push the rents as high? And there's all these objections. Absolutely. Just like the stock market, right? There's all kinds of ups and downs. The difference is when you buy the property right and you put in all kinds of conservative underwriting measures that can assist you, the chances are that executing your plan even halfway is going to still yield two
That's
times
right.
the type of returns that you're going to get in the stock market, maybe 1.5 times the returns. So, and that's just what we found across the board. So you can get into a very conservative deal with people. You can get into higher risk deals, whether it be multifamily, single family, or even apartment, what do you call it, mobile home parks and things like that. But this is real. These numbers are real, and we've accounted for everything in them. So
These are conservative industry standard returns. Now, you might get on a deal where we don't quite hit the numbers, but because you're investing in a lot of deals, you're most likely going to be on deals where we beat these numbers. So all you got to do is average out here to hit these numbers. And your 2 times your money in 5 years is very achievable for us as a team on these properties. So Chris, I would call this conservative in my opinion.
yeah, I mean, I guess you're okay with that, Paul, because you retired at 43. So I'm I'm a little more conservative even than you are, but you're absolutely right. I mean, it is what it is, right? I can tell you guys from my personal portfolio before I even got into the larger multifamily space, I have lots of single families, duplexes. I've done land construction, different businesses I've built, and there's just no vehicle on earth that's close to it, right? Buying a single family home and cash flowing $300 will multiply that by hundreds, okay? And then everybody just offsets the risk. We get a lender involved. We got all the SEC documents, and it's all regulated. It's good stuff. So let me just give you this one example for Paul. Let's use this example. I just love this example. And this is real. This is someone who has partnered with us and given us permission. We're not going to use the name, but let's go ahead and use an investing period of what was it, Paul? It was 1 year because they're retired technically, right? So they can't put, or no, we're going to go 20 years with no, only an initial investment. So let's go 20 years. Go 20 years for me.
Okay.
And let's go $300,000.
Chris, where was that 300 from?
That was
They
from
just
a
had it in cash, or?
Yeah, no, this is a retirement account. Okay. Low tax bracket. About half of it was actually in a what do you call it? Like a stock fund that they had to cash out. So there's just different advantages to all these types of accounts, but for the purposes of this example, we're just going to say 300,000.
Are they contributing anything?
They are not going to contribute anything. Okay.
Okay.
So they're retired and they have a $600,000 retirement portfolio, and they put 300,000 in a deal. Okay. So that's what this example is, because they don't really have any money to put in because they're retiring. They're literally retiring this year. Okay. They need the money for 20 years though. Okay. So they're not contributing at all, but they need the money for 20 years. Go ahead and calculate and let's see what those numbers look like.
So now, Chris, this income is in year 21. So obviously this is fantastic because they started with such a big initial investment, and then that had the chance to compound over 20 years. So in year 21, they're actually close to $20,000 a month in income. But I'll show you something real quick over here. We can watch their progression of cash flow. They start out at 21,000 a year annual cash flow, and it grows 25, 25, 40, goes up to 40,000. They're up to 50,000 in year 9. All right. In year 11, 12, they're at 85,000. As you can see, it just grows.
Now, Paul, yeah, go ahead. I want to clarify this though, because the numbers are really big. So we don't want people thinking, wait a minute, that's impossible, 20,000. Here's why they're so big, because the model assumes that money's being reinvested.
That's right.
They're not living off that cash flow. Okay. That's just that assumption, but I'm actually going to give you the real numbers because I have them in my head. Are you good with that, Paul, for right now? If I give those numbers?
Yeah. And I think we should change the cash flow reinvestment to 0 if we want to say they're going to live off this money, we could do that too.
Change it real quick and hit calculate. Go down to the bottom. Okay.
All right.
So
that's
here,
with them pocketing all the cash flow.
Right. And that's the example I wanted to give you because this is real. Okay. All this other stuff is, hey, we're checking it. We're trying to see where we'll be, what will happen. This is a real example of somebody who actually put in. Okay. Now, again, this is not an offering. This is not a guarantee, but I can tell you because we have lots of investors do deals with us. This is an example of somebody who put 300,000 in, and the cash flow off of that money, off of a deal, is somewhere in this ballpark. Okay. Now, that's assuming that they're in for that long period of time. But let me just give you an even more realistic example. This particular individual told me that their financial advisor said, if you invest all your retirement, let's say 600,000, and just convert it to a bond fund, and you need to live off of it, you'll get about $1,000 a month off that money. And in 20 years, when you're 85, you'll have about $250,000 left. Okay. So the financial advisor told them 650,000, you're going to live off it for 20 years. When the 20 years comes, you have 250,000 left. And congratulations, you would have got $1,000 check every month for 20 years. I don't know about you, but that doesn't seem like much to me. Okay. That was their financial advisor taking all their stuff into account. We talked to them and reviewed all this stuff, and we had a hot deal at the time, and they were already in the funnel. So we were able to make an offering to them. We put their money to work for them, but we only took half that money. We didn't even need the 650. We said, why don't you try 100? They insisted we want 300. They put 300 in. That 300 day one, basically, now it takes a few months to stabilize, but say day one, is actually returning close to $2,000 a month in cash flow. Okay. By being in the right asset class. Now, here's what's amazing. If you look at the calculator, that asset grows. So instead of them eating up or chipping away at the cookie, they're making more cookies. That's what's great about multifamily is those assets grow with forced appreciation, right?
So they're living off their cash flow, and their 300 turns into about 2.6 million
in 20 years. Right? So instead of only having 250,000 in 20 years, it is actually growing exponentially, and they're living off more cash flow. Now, again, full disclosure, these are not guarantees, but the math is pretty solid. We've had several CPAs actually look at this stuff, and it's not rocket science. It's just Wall Street doesn't want you to know this.
They don't
stuff.
want you to know.
And they also want you to think it's pain and suffering to deal with property. Yeah, maybe some single family stuff, but you've got an army of people. I mean, we have about 8 people on our team with the CPAs, the admins, the asset managers, the financials, all those people that are working to make sure we all get good returns for our money. So I don't want to spend too much time on it, but I really want to hit home with how much fun it can be to plug the numbers in to your realistic scenario, to hit your real cash flow numbers, right?
How can you hit your freedom number in a combination of money and duration, and play with those combinations and come up with a real plan for yourself? And if it seems like it's going to be tough, figure out a way to make your plan work. If it's like, I need to retire, I want to be done at 55. And when I say retire, I don't mean you're just sitting around doing nothing. That just means you're free to do what you want. right? And if I want to do it in 12 years, well, this will tell you using this model what you have to do, how much you have to invest per year to make that happen, and then use that as your financial plan.
Yeah, absolutely. And so there's several different ways, folks, that you can get into these deals. You can use IRA money. You can convert IRA money into like solo 401ks and EQRPs. You can use cash. There's all kinds of fun ways, and we encourage you to educate yourselves and learn more about that. But in my opinion, the best way to get to wealth is to create cash flow, passive cash flow, and multiple streams of income. And this is one way for you to do that. You might want to stay in stocks. You might want to get a little bit here. You might want to go over to a single family residence and then have a job. And maybe you got a little side gig you do as well. Maybe your wife is into Mary Kay or something, which is great. I happen to have a best friend that's wife is into Mary Kay. She's a rock star. That's why I mentioned Mary Kay. But you have to diversify and you have to create the cash flow, because if you have a significant event in your life, a health issue or something comes up, you can sleep well knowing that that cash flow is coming in for the most part, because there's an army of people working to make sure that it does. And if your team buys the right assets, then you're pretty solid, right? Now, also, if you end up getting into a deal like this, I referenced PPMs, which are private placement memorandums. There is a lot of legality, a lot of attorneys, a lot of paperwork that goes into these things that you just have to sign and read through. So just be aware, if you do vet a sponsor group, like say Paul and I and our Sterling Rhino team, then you would get all these documents that lay out the opportunity that you get to then go through and vet and cross-reference and check with your attorneys and or CPAs, and then sign that stuff before you ever transfer any money or any of that. So this is just a tool for you to see the power of what syndications can do. So do you have anything closing, Paul, before we get to our last slide?
If you want to come up with a plan for yourself and you're a little intimidated by this, watch the instructional video, then set something up with me. You can email me at paul@Sterling Rhino Capital. I will do a one-on-one, or Chris will even do it. And we can walk you through this and plug in numbers, make sure you're doing it right, and come up with a real plan to use this model to build serious wealth for yourself.
Yeah, I mentioned it earlier. It's so taboo. And I just want to shatter those glass walls. Like I want people to feel very comfortable talking about money, because money doesn't build happiness, but it sure gives you freedom. It sure can make you feel better. If you got a family member that needs some assistance, or you got to take care of some kids or something, what better way than to know that you've got that cash flow coming in and you don't have to freak out and stress about things, because we're all one life situation away from failure if we're not careful, right? And so we need to talk about it, get comfortable with it, share our stories, and help each other get there, right? And that's why this is so powerful and so much fun. We love this space. We love syndications. We love taking properties that need help and building them up and helping the communities in the area at the same time.
Yep.
We give back. We're partnered with Feeding America. We fed 177,000 people so far. We're trying to get to 1 million. We have a lot of fun in this space, and we'd love for you guys to be part of it. So let's get on to that last slide, and we'll let everybody get back to their lunch or whatever it is that they're doing. Let's see here. Okay. All right. So I asked you earlier what your number was. What's your freedom number? I want you guys to think about that. What's your freedom number? What number do you need to retire early and live a life of abundance on your terms? That's the key. Maybe you don't want to retire. Maybe you just want that extra cash flow because you want some freedom, want to spend more time with your family, whatever it may be. If you're interested in learning more, you guys can check us out at sterlingrhinocapital.com. We're on Facebook, Investor Think Tank, and YouTube. We've got lots of educational videos on YouTube. So please check us out there and subscribe. You'll get all the updated videos. We're adding like 20 in the next 2-3 weeks. And then you can also join our investor club at one point on our website where it says get started, or you can just download the calculator. No obligation. You'll just get into our funnel where we send you a lot of educational emails and encourage you to sign up for the investor club. So that way, if a deal does come up, we can offer it to you, because per the SEC rules, we can't just offer you a deal. We have to have a substantive relationship with you. So make sure that you get in that as well. Let's see. Cool. If you're already, I have some people chatting in. If you're already in our investor club, that's fabulous. We'll continue doing these educational webinars on different topics. We're really excited to bring a bunch of new stuff your way and help drive you to that early retirement number if you so decide to retire early. So no need to sign up if you're already in there, but we just want the folks that are not to know. And if you have somebody you think could benefit from this tool, please, please, please share it. Reach out to us. We'll share this recorded webinar with you, and you could share it with your friends and family. Oftentimes you talk about this stuff and they don't know what you're talking about. People might think, oh, how do you buy big buildings? How do you do this? How do you do that? And it is real. And these these numbers, they're real. So feel free to share the tools. Yeah, they're achievable.
This is
absolutely
very achievable.
We're doing it. No problem.
Yep.
It's great. Yeah. So I thank you so much for your time. Again, this is Chris Roberts, CEO and founder of Sterling Rhino Capital, and co-founder and COO, Paul Wilcox. We thank you guys very much, and enjoy the rest of your day.